Okay, so in this video I'm going to discuss how supply and demand forces can impact gold prices. Now, I'm not going to talk about all these other 16 points that you see here on the slide, because that would make the video way too long. So I'm actually just going to focus on supply and demand forces, and for all these other points, I'm going to make separate videos for each and sort of turn this into a video series slash playlist. But anyways, let's start with the video. So on this slide, I've got supply and demand diagram and some supply side and demand side determinants. Now, the reason why I got the supply and demand diagram here is because I wanted to talk about some fundamental economics related things before I get deep into the determinants. So the important thing about this diagram is that it is simply a model that shows us how any market really works. Well, in this case, the gold market. To keep it simple, on the y-axis we got the price, and on the x-axis we've got quantity. The green line represents supply, which shows the quantity of gold firms are wishing to supply and for what price. And the red line represents demand, which shows the quantity of gold consumers, customers or investors wish to buy and for what price. Now, in markets, it is said that firms follow the law of supply. As the market price increases, the quantity supplied also increases, and vice versa. As the market price decreases, the quantity supplied also decreases. Now, in the former case, this happens because hikes in prices incentivize firms to produce more of that good or service in order to increase profit. In this case, gold, produce more gold or sell more gold. And since the profit is the measure for success for firms, the more they make, the more successful and larger that firm becomes. Consumers, on the other hand, they are said to follow the law of demand, which is as the price increases, quantity demanded decreases, and vice versa. As the price decreases, quantity demanded increases. So, but why does that happen? Well, the measure for success for consumers in the market is maximizing utility. Now, if the economic good in question is overvalued, let's say, and thus overpriced, then that means that if the customer were to buy that good at elevated prices, the utility they get from that good will be lower or actually non-existent compared to when the consumer bought the good when it was at equilibrium price, let's say. But what do I mean by equilibrium price? Well, first we need to understand what a market in equilibrium means. So, the market is said to be in an equilibrium or balance when the interests of all agents in the market align. So we can actually see that here in the middle. We can see it right here. So this is the point at which supply and demand, which represents the plans of both agents in the market, this is where they intersect. So that means that our equilibrium price in this diagram is actually P2 and our equilibrium quantity is Q2. So yeah, now the thing about equilibrium prices is that they are essentially the market price or the going price, because all agents in the market, through their interactions, through their trades, have decided that the price should be, or the price should settle at P2 or P1 or P3. Now in this example, the market is in balance when the price is P2 and the quantity is Q2. But that kind of reveals another important thing about equilibrium prices, because equilibrium prices can change due to changes in one of those or many of these determinants. For example, let's say the news comes out saying a mining company has discovered a large quantity of gold in country X, right? So that constitutes an increase in supply because they discovered a lot of gold, so the market is going to be the market is going to experience like a larger supply of gold entering it. So because of that, this supply line here is going to shift to the right. So in the market, when one of the determinants, such as miners, when that increases, the line shifts to the right, and when let's say the supply is decreasing because miners are not being able to find gold, then the line will shift to the left. Right, it's gonna be like this. Now, in the former example, right, when this happens, so the mining company has discovered more gold, so now the supply of gold in the market has increased, right? So when this happens, when this supply line shifts, that means that the equilibrium point where the plans of all of our agents meet at this intersection has shifted. It was around P2, but now it's around P1.6, let's say, right? So that means that the price has decreased. The price has decreased because there is a larger supply of gold, and the market will get balanced over time because if the price decreases, then buyers in the market, they're gonna start buying more gold because it is now more affordable, following the law of demand, of course. So this is what would happen in an ideal scenario. Now, in the opposite scenario, if the miners were struggling to find gold, then over time the supply of gold will be insufficient. They won't be able to meet demand, so there's going to be some kind of acute shortage in the market. So that means the supply line or the supply curve is going to shift towards the left, And what happens to price? Well, now the price will settle at P2.3 or 4, so it's higher than before, right? At the same time, the amount of gold buyers will want to buy is going to be less. It's going to be at around Q 1.3, let's say, but previously it was Q2, right? So the buyers will want to buy less, but the firms will want to sell more at these elevated prices. So if they're selling more, the quantity supplied will increase, and over time the market will balance again at Q2. So the market will always find the balance. In an ideal world, the the price will always go back to the equilibrium price. It will always settle at the balanced price, at the fair price. Now we can do the same thing for all of these determinants, but I'm just going to talk about all of these in a like very briefly. I don't want to make this an extremely long video. So if you talk about mints, so I put mints here on the supply side determinants, and what I mean by that is, so mints produce gold coins, they produce gold bars, they they're not only just producing bullion for investment, they're also making collectibles, items more geared towards numismatists and people like that, collectors. But anyways, if the mints, if they start to produce less bullion, less gold products because of some kind of shortage in the market, let's say, then what does that mean? Well, that will mean that the price of all these products will increase, especially their premiums. I mean, the gold price is gonna go up and down, just normal every day, like it always does. But the premiums are gonna change. So the premiums are going to increase because of that shortage. If that happens, then the demand is going to change. These products are going to become more expensive, so consumers in the market, in the gold market, will be unable to buy large quantities compared to before. So, and of course the actual price of gold will also increase, like indirectly, because obviously there's a shortage in the market. So not only are the premiums increasing, but also the gold price, the actual gold price, is also going to increase. So that's just gonna make the total price, the aggregate, extremely high. So that's a huge problem. That will create a huge problem in the gold market. But it will be obviously advantageous for people who bought the gold early on when it was cheaper. Now I also have supply chain here, and what I mean by that is deliveries, like logistics. So this is kind of tied to oil prices, let's say, or petrol prices. So let's think about a disrupted supply chain. So a disrupted supply chain would be like high oil or fuel prices. So that will mean that it's going to be more expensive for suppliers to deliver gold to bullion dealers. So that's kind of like from mines to bullion dealers perhaps. But not only that, it's going to be also more expensive for gold dealers to deliver the gold to buyers. So obviously that has an impact on premiums as well. So if the cost of the logistics increases, then premiums for gold coins and bars will also increase. Okay. So then, on the contrary, like if the supply chain is smooth, then there won't be any issues. The premiums are going to stay low. There's not going to be changes whatsoever to the premiums. It's probably going to stay neutral, or it will decrease slightly. Then I've got bullion inventory. So what I mean by that is there might not be a shortage in the gold market, like looking at the gold market in its totality, but there might be a shortage within the bullion dealers themselves, because perhaps the mints produce less gold coins and bars, or just the dealers are not getting enough customers, things like that. So they might have shortage because of those reasons, but mainly the reason why bullion dealers have have an issue or face issues with their inventory is mainly due to lack of customers, especially like when um, everything is going good, the economy is fine, nobody's coming in to sell their gold. Very few people come in to sell their gold. So yeah, there might a lot of dealers might lack products. So there's like an internal shortage, but overall in the whole market there is no shortage. But still, that's going to affect the prices. If the gold dealers are lacking products or facing shortages, they will bump up their premiums. So after that, I've got central banks, sort of central bank activity. So they're because central banks are big players in the gold market. So if a lot of central banks around the world are buying huge amounts of gold, then that of course represents elevated demand, which means the price of gold will increase. Um, so on the, I mean, the because I mean, if there are economic issues, let's say inflation, I just find it really funny that they central banks can buy gold to buy the gold to deal with the problems that they created. I mean, that's just incredible. But anyways, in the contrary situation, if a lot of central banks are selling gold in the market, if they're selling large amounts, then that represents a oversupply in the market, and that's gonna cause less demand, and it will cause the price to decrease, to fall. I mean, central banks they own the most amount of gold in the world, so they are huge players, and whether their net whether they are in net buying position or selling position, they're going to influence prices for sure. Then I've got speculation and manipulation. So basically I'm referring to the ETF trading activity. So the thing about the gold market is that there is a few whales. By whales I mean high net worth individuals or financial institutions like central banks in the market, which can drive the price of gold up by putting large buy orders and sell orders, mainly sell orders, to drive the price down. Of course, you can also make the case of like hedging. So let's say you're a gold dealer, you're selling physical gold. So you're selling physical gold, but in the ETF market, you might be buying, right? But most of the time, what happens is gold dealers, they buy gold from people for a discounted price because they're paying below the spot price. So they're buying it from the people for a cheaper price, but they're putting a lot of sell orders in the ETF market. So what that does, if you can drive the price down, you can acquire more gold for really, really discounted prices, right? So they're putting contrarian positions. In the real world, they are buying. In the ETF market, they are just selling. So they're just hedging at that point. So then we got GLR, which is the gold lease rate. So this is something only central banks can do, which is they can actually lease or rent out gold to other central banks or other financial institutions. So I'm gonna make a really in-depth video about this later on, but essentially when the gold lease rate is low, that will make it a more attractive option for financial institutions to rent out the gold. So that constitutes a higher demand in the market. It increases demand because more gold is taken out and leased, which actually acts like a de facto short selling, right? So because of that, actually I need to take a step back here. So when the gold lease rate is really high, that constitutes low demand for gold leasing, because it would be more expensive due to a higher lease rate. It will be more expensive to do so. So there is no incentive there to rent gold because the rate is too high. Now, when the GLR is low, that makes it more attractive for institutions to lease the gold. And if it's more attractive, if it's cheaper, right, because it's lower rate, then that would mean more gold is leased, which is short selling, right? That's how it works. It's a de facto short selling, indirect short selling, which causes the price to drop. The more they rent out, the more the price of gold will drop. Okay. Then after that, I've got world events or local events. What I mean by that is, let's say there was a mining accident, so that's going to affect both the supply and demand, because because of that accident there will be less supply of gold. B, the mining company will receive less investment because of that accident, as they might be viewed as an irresponsible company, and etc. And of course, less investment in the mining company or companies would mean less gold is discovered and supplied, which is gonna create a shortage in the market and also cause the price to spike. And finally, C, the last point, the workers who got injured or died because of that accident will serve as an example why others should not work in this industry. So that's gonna create a labor shortage in the gold mining industry as well. So if there's less labor, that means less gold is going to be produced, or you're gonna have less workers to take the gold out of the mines, or you're gonna have less miners doing the job. So you got a shortage uh, in discovery, shortage of gold, but you also have a shortage of labor in the market. So that's gonna cause the price of gold to spike quite a lot. Although you could also make the argument that the price might decrease, because obviously if such an accident occurs, then people are gonna see this as a negative piece of news. So that's gonna discourage people from investing in gold. So the price may fall in the short to medium term. But overall, if you look at the impact on the market, I mean, it's probably going to spike up a little bit. So these are the supply side determinants. So switching over to the demand side determinants, so I got preferences. So by preferences, I mean I'm referring to the gold confiscation that happened in the US in 1933. Executive Order 6102. So what do I mean by this bullion slash jewelry? So what I mean by that is when the gold confiscation happened, that confiscation mainly applied to items with like high amounts of pure gold content. So we're talking about anything above 90%. Of course, jewelry is not 90%, but most of the time, jewelry is like 50%, 60, 70, 80% pure gold, or even like really low amounts, could be 10%, could be 20%. But the main thing is jewelry was sort of exempt from this confiscation, because there was a case where a woman traveling abroad while traveling to the US, I think, who basically put a lot of jewelry around her body, but they they did not confiscate her gold, um, her jewelry, because jewelry is so impure, and it could be fake as well. So jewelry sort of acts as a way to bypass the gold confiscation. So if the preferences change because of a confiscation, then bullion becomes less attractive, but jewelry becomes slightly more attractive in terms of investment. But of course, jewelry costs a lot of money, and you're overpaying for the amount of pure gold content that is in it. So it is um, it is a bit difficult, but um, yeah. So it can help in these kind of scenarios. Um, but bullion, if there's no confiscation or anything like that, then of course just pure gold bullion is gonna be fine. And even if there was a confiscation, I mean, you could hide it. I mean, this is like nobody. I mean, nobody can know um, who really has gold and how much. It's just impossible to know. Okay, so after that, um, we got buyer's income. So buyer's income, what do I mean by that is what I'm referring to mainly is disposable income. So so if disposable income in the economy is high and the economy is going good, luxury goods purchases are going to increase, and gold is included in that, of course, which can bump up the price slightly and also compensate for the less amount of investment demand as well. But if buyers' disposable income is low, and I mean in the whole economy in aggregate, then less luxury goods will be purchased and more investment demand, and there will be more investment demand actually, which will also bump up the price. There we go. Dealers premiums on physical gold. So basically the way it works is if the dealers premiums are high, then demand will decrease and the price will drop. And if dealers premiums are very low, demand will be higher and the price will increase over time. Buyer's culture, what I mean by that is in different cultures around the world, like in some cultures, gold is coveted more, and people are have have more like financial education. They know the role of gold in terms of protecting your assets, protecting yourself from inflation, from risk, geopolitical risk, and vice versa. So, for example, I mean, in India, gold is really important in marriages, because obviously gold is used as dowry. Um, so that means that um, the demand will naturally be higher in India, uh, in the Indian gold market compared to the West, for example. In China, a similar story. Gold isn't used that much in marriages, but China has more of a saving culture compared to the West. The West is more about consumption and it has a lot of debt. Um, so yeah, all of these um, can influence prices to some degree. So in China also gold investment is much higher um, because people um, do have a better financial education and literacy. Um, Also, the Chinese do have a dream um, of having the yuan or the new yuan to be the world reserve currency. Okay, then we got taxes. So in the UK, for example, there is capital gains tax. Now, the British gold coins produced by the Royal Mint are capital gains tax free, right? So, if you're in a country where capital gains tax is applied to gold, so that's going to have a downward pressure on the gold price because that's going to discourage people from buying gold. It's gonna make it too expensive. I mean, imagine the tax hikes plus the premiums plus the capital gains tax. I mean, that will just make it a horrible situation for um, the buyers, the people who own gold. It will make it horrible for them. Um, However, if if the gold coins and the bars are capital gains tax free, then that's obviously going to incentivize people to buy gold, of course. So if CGT is applied, lower demand, price drop. If it's CGT free, then higher demand and price increase. So after that I've got storage cost. So very simple. By storage I mean vaulting around the world. Is it going to be Switzerland, UK, Singapore, or wherever, right? Storage costs can change, and if storage costs get too high, then there will be lower demand for gold and for vaulting services. So therefore, the price will drop, and if the storage costs are low, then there will be higher demand for gold and higher demand for vaulting services, which then will increase the price of gold over time indirectly. After that, got currency weakness. So we got dollar or local currency gaining strength or becoming weaker. So when the local currency or when the dollar is weak, then typically that causes demand for gold to increase, which then causes the price to rise as well. However, when the currency gains strength, what happens is the demand drops, demand for gold drops, and the gold price decreases. of course, if the currency is getting stronger, that means, it requires less currency units to buy the same 1 ounce of gold. And if the currency is getting weaker, you need more currency units to buy the same 1 ounce of gold. Then we have I put how Russian gold was treated. So what I mean by that is because of the Russian and Ukraine war, Russian gold exports were banned by various countries, G7 countries such as the UK, Switzerland, and some other G7 countries. They effectively what that did is what that did was effectively prevented Russian mining companies and banks, as well as wealthy individuals, from getting their hands on gold to swap for hard currencies. In this case, the Russian ruble. So in theory, all of this should have caused the price of gold to spike, because the supply, which is being specifically restricted due to the ban, and of course restricted supply normally equates to a price spike. But what the LBMA said at that time was that the gold price will be largely unaffected, as there is enough supply to meet the demand at the time, and they were saying that it might go up a bit, but it's not going to be a huge increase in price. And they were indeed correct, because the gold price on the 26th of June, which is when this ban was implemented, so the price of gold on the 26th of June and beyond was the price on the 26th and beyond, it increased very slightly, because the gold price actually went from around $1,824 to $1,840 the very next day. So after the 26th, after when this ban was announced, which of course is just an increase of $15, but in percentage terms, we're talking about 0.83%. So obviously it's a very slight increase. But after this event, gold entered a downtrend, which was quite weird, because obviously the supply was being restricted, but there's still other producers in the market. I mean, there's gold being produced in South Africa, Mexico, many countries. I mean, banning Russia is not going to affect supply a whole lot. But I think in this scenario, the speculators affected the price a lot. There was a lot of short orders in the market. It was a very strange situation. So gold entered a downtrend. The price decreased to $1,682 by the 21st of July. So yeah, very very crazy moves there. So the stock market. So everybody knows the inverse relationship between the stock market and the and gold. So typically what happens is when stocks are overvalued, gold price surges, and when when stocks are undervalued, the gold price decreases. So when stocks are overvalued, especially after an injection of cash by the central bank into the market through quantitative easing, we know these prices are fake. I mean, stocks increasing when they shouldn't be, in theory, when the economy is actually tanking, but it's just, we know that they're trying to keep the market in on a lifeline, to prop it up, and that of course makes gold more attractive at that point. Because if stocks are really strong, they're really high, that automatically means that there is not a lot of interest in gold. But obviously, after seeing that this is actually happening, people start to protect themselves. So they take the contrarian position. They start to buy gold. So demand for gold increases at that point. And the opposite happens when stocks are undervalued. When stocks are undervalued, then stocks are more of an attractive option, right? You're gonna get dividends, you're gonna get capital gain when the share price rises. So investors get more of a benefit from stocks when they are undervalued. And yeah, so I think that's the video. We talked about all of these different kinds of supply and demand forces, and yeah, I think that's about it. On my next video, I'm gonna talk about the speculative forces more in a more in-depth fashion. It's going to be a very interesting video, but I think you'll be the judge of that when you see it. Alright, that's it, and goodbye from me.